Okay, let's unpack this. We're doing a deep dive into the defense industrial base today. Specifically, we're digging into the Northrop Grumman third quarter 2025 conference call from October 21st.
Yeah, that's the plan. Taking all this dense financial stuff, operational data, and really pulling out what matters strategically.
Right. We need to figure out where this defense giant actually stands. Financially, program-wise, especially with everything going on globally, demanding everything right now.
Exactly. Capacity, next-gen tech, the works.
And the top-level view for you, the listener, it looks, well, deceptively simple, but really strong. It was a quarter really defined by, executing well under pressure. They hit mid-single-digit growth.
About 5% organic growth year over year.
Yeah, 5%. And margins expanded, too, hitting a pretty solid 12.3% segment operating margin.
Which is good, but look, if there's one number that kind of signals the future trajectory here.
Let me guess. Book-to-bill.
You got it. The book-to-bill ratio. It measures new contracts coming in versus sales going out the door. It was 1.17 for the quarter.
Wow.
Exceptionally strong. It's a massive sign. They're piling up future work faster than they're completing current stuff. Huge demand signal.
Okay, so let's get into that financial scorecard then, because, things get interesting pretty quickly.
They do.
Total sales for Q3, $10.4 billion. That's up 4% overall. And get this, international sales growth was up 32% just for the quarter.
Huge jump internationally.
But here's the twist, right? They actually revised their full-year 2025 sales guidance down a tiny bit, now looking at $41.7 to $41.9 billion.
And that's the key detail to kind of parse. Sales volume is a little lower than they thought it would be.
Why, though?
It seems mostly timing. Delays in getting contracts finalized, awarded, probably linked to the budget uncertainty back in D.C. But honestly, that's the least interesting part of the guidance update.
Wait, hang on. Sales guidance down, but profit guidance up. How does that work? Is that just, fancy accounting? Or did they suddenly get way more efficient?
It's definitely the second one. It's operational discipline. See, even though they expect slightly less revenue, they kept their segment operating income dollar guidance the same.
Ah, okay. So making the same profit dollars from fewer sales dollars.
Exactly. It means they're just executing better, making more money on the work they're doing, especially the higher margin contracts.
So doing more with less volume.
Yeah.
Better efficiency, maybe better pricing power on some things.
Precisely. And this focus, it pushed their segment operating margin rate up by 10 basis points compared to what they guided before.
Okay, 10 basis points. For those of us not living in spreadsheets, that's like 0.1% improvement in the margin rate.
Yeah, basically, it proves this efficiency push is actually paying off. And because of that operational performance, they felt confident enough to raise their MTM-adjusted EPS guidance quite a bit.
How much?
By general, 65 cents. So the new range is $25.65 to $26.05 per share.
So let's pause there. MTM-adjusted EPS. Sounds complicated. Why is that particular number and that raise so significant?
Well, it is a bit complex, but the takeaway is simple. Profit stability. MTM stands for mark to market. Adjusting for it usually smooths out things that aren't core to the main business, like pension fund swings or investment gains.
Okay.
So by raising the MTM adjusted EPS, they're signaling that it's the core operations driving this better profitability. It's not some one-off financial event.
Got it. Real improvement, not just noise.
Exactly. And they also stuck to their free cash flow forecast, still expecting between $3.05 and $3.35 billion. Strong cash generation.
Now, if we look at the different parts of the business, the segments, you can really see where that margin strength is coming from.
Oh, yeah. Defense Systems, or DS, had a fantastic quarter. Sales jumped 14%, almost 19% organically.
19% organic. Wow.
Yeah, with a solid 11.4% margin. That was driven by things like ammunition, weapons, the IBCS system we'll talk about, and the Sentinel missile program. Big hitters.
And Mission Systems, MS, was also really strong. Double-digit sales growth, 10%. But their margin, it jumped significantly, 16.7%.
Yeah.
That's a huge margin rate. What happened there?
Yeah, that was pretty eye-popping. A big part of that bump came from their restricted advanced microelectronics portfolio.
Okay, what's that?
Think of highly classified, very cutting-edge chips, stuff designed specifically for, sensitive government applications, a tough market to be in, high barriers to entry.
Right.
They got a specific $68 million favorable adjustment tied to hitting a milestone in that portfolio. Plus, they saw continued strength in international sales of ground-based radars, so really strong execution on these super technical, high-margin programs.
So the only segment that looked a bit soft was space systems. Sales down 6% year over year.
Yeah, but that was completely expected. No surprise there. It was just the planned wind down of two really large multi-year space programs. The work finished, so the revenue drops off temporarily.
Like finishing a big construction project.
Yeah, exactly. But management sounded confident. They said the segment is, quote, poised to return to growth. New awards are expected to fuel things again starting in 2026.
Okay, so financials.
Yeah.
Sales a bit tighter, but margins better, because they're executing really well. Let's talk about why they can pull that off.
Yeah.
It seems to come down to discipline on their biggest, most important programs. Let's start with the B-21 Raider.
Ah, yes, the B-21, the next-gen stealth bomber. Big news there. The source confirmed the second B-21 test aircraft actually started flying in Q3.
The second one is flying. That's a major milestone, right? Moving beyond just the first prototype.
Huge milestone. And it signals a shift in the testing itself. They're moving past just, basic, can it fly safely checks.
And into the complicated stuff.
Exactly. Integrating the weapons systems, the mission software. That's the really critical phase. Plus, they said they're still on track to get the advanced procurement awards for the third and fifth low-rate production lots later this year.
LRIP lots 3 and 5. So the government's definitely pushing to get these things built faster.
No question. Which leads to the next point, acceleration talks.
Right. Are they actually going to speed up production?
Well, they confirmed active negotiations are happening with the Air Force about an agreement to do just that, accelerate the B-21 production rate.
That would be a massive undertaking. Huge investment needed, I imagine.
Oh, absolutely. Big capital spending required. But it shows you how urgent the Air Force sees the need for this plane. And here's a key thing. Management specifically said this potential acceleration is not currently baked into their 2026 outlook.
So that's potential upside. More revenue down the line if it happens.
Significant upside potential for revenue, yes, though probably requiring big investments up front, like we said.
Okay, moving from bombers to missile defense and battle management, connecting everything on the battlefield. IBCS, that system seems to be on an incredible roll.
It's honestly remarkable. IBCS, the Integrated Battle Command System,
Yeah.
It's their main command and control network. It just completed more live fire tests for both Poland and the U.S. Army.
And the record.
Still perfect. 32 for 32 successful flight tests.
32 for 32. I mean, in missile defense testing, that kind of perfect record used to be unthinkable, right? Failure was almost expected sometimes.
Absolutely. It's a monumental technical achievement, shows huge confidence in the system's maturity. And they're not stopping there.
They're upgrading it.
Yep. Adding cloud capabilities, mobile tech, more AI integration. They expect IBCS to become a, quote, significant double-digit growth driver starting in 2026 as these advanced versions get fielded internationally.
And at the same time, they're shoring up Homeland Defense. Got a big extension on the ground-based mid-course defense system, GMD.
That's right, a multi-billion-dollar extension carrying them through 2030. And crucially, it includes the work to integrate the next-generation interceptor, the NGI, and upgrade all the communications for the whole GMD system. Foundational work.
Okay, last big program area, rockets. Solid rocket motors, SRM. They seem to be making some really aggressive moves here.
Oh, definitely. It's a clear strategic focus, responding to just massive global demand for missiles, interceptors, space launch. Their GM-63XL boosters, for example, they just powered another ULA Vulcan rocket, successfully launching the third batch of Amazon's Kuiper satellites.
So the Kuiper constellation is becoming a steady customer.
Seems like a key, reliable growth driver for their space segment, yes. And maybe even more significantly, they leverage their own investments in rocket motor tech.
The ones they funded themselves.
Exactly. And they won a spot as the second supplier for the Navy's SM-6 missile.
SM-6, that's a critical fleet defense missile. Being a second supplier is a big deal. Breaks the monopoly.
Huge deal. They basically invested ahead of demand, built up capability, and then challenged the incumbent supplier. It signals a real shift. And to back that up, they talked about capacity.
What do they say?
They've substantially expanded it, Tactical missile SRM capacity has been, quote, more than doubled, and they're already breaking ground on another new facility that should be online in about 2 years.
Wow. Doubled and building more.
That level of aggressive, forward-looking investment is maybe the biggest strategic theme this quarter.
Yeah, that's a perfect transition. Let's talk about that strategy, the investment underpinning all this, because this isn't just routine spending, is it? It feels like Northrop is making a huge bet that the government needs this capacity and will reward them for building it.
It absolutely feels like a strategic differentiator. They mentioned allocating over 4% of their sales to capital expenditures, CapEx.
Over 4%. That sounds high for defense.
They explicitly said it's well above industry averages. And it's not just for keeping the lights on. It's targeted investment, new factories, more capacity for next-gen systems, munitions, microelectronics. Exactly what the Pentagon's been asking for.
And it's not just physical factories, right? They're investing heavily in digital tools, too.
Yeah, over $2 billion committed to an enterprise-wide digital transformation. They called it game-changing. Apparently, they're seeing, quote, extremely high correlation between their digital designs and the actual physical products.
Which means?
It means faster development, fewer expensive mistakes, more predictable performance, more affordable systems for the customer. That's a massive selling point when you're bidding on government contracts.
And they're still funding R&D, internal research.
Yep, IR80. Over $2.1 billion invested just in the last 2 years, focused on the next horizon. Multifunction sensors, AI integration, smarter weapons, keeping that technological edge 5-10 years out.
All this investment, especially in things like microelectronics, it also helps tackle a huge industry risk, doesn't it? Supply chains.
Absolutely. That's a key vulnerability for the whole defense sector right now, dependence on foreign sources for things like rare earths, and especially advanced chips.
So how is Northrop mitigating that?
Well, it helps significantly that they operate 2 of their own domestic microelectronics foundries. They design, build, and package their own specialized chips right here.
Giving them control.
Exactly. And interestingly, they mentioned they're now starting to open up these advanced foundries to other customers too, even commercial clients.
Really? So selling chips on the side?
Sort of. Building on the roughly $1 billion a year in chips they already make for themselves and other national security customers. It diversifies their foundry business, makes those huge investments even more efficient, and reduces their own supply risk. Very smart.
And tying this all back to the start, the geopolitical situation is the engine driving so much of this. That urgency for allies to modernize.
It's palpable, isn't it? Driving that strong international growth we saw. Allies are prioritizing spending on air and missile defense, radars, ISR, that kind of high-end systems Northrop excels at.
Okay, looking ahead then, what's the outlook for 2026?
The initial outlook anticipates mid-single-digit organic sales growth, but importantly, across all 4 segments.
All 4. So more balanced growth, not just relying on 1 or 2 hot areas like this year.
Exactly. Suggests a more sustainable growth profile moving forward.
There are some big ifs attached to that outlook, right? Some footnotes.
There are. 2 massive opportunities are not included in that 2026 baseline forecast.
Which are?
The potential win on FPXX. That's the Air Force's next-gen fighter program competition, and that B-21 production acceleration we talked about.
Okay, so winning either of those would be huge long-term.
Absolutely. Huge long-term value. But they'd require significant upfront investment and would likely start with lower margins, which is typical for early production or development work. So big potential, but also big investment needed first.
Got it. And finally, we have to quickly touch on a risk factor they mentioned. The call was in October 2025, and the U.S. government was shut down at the time.
Right. A crucial bit of context. Their updated guidance assumed that shutdown would end relatively quickly, like around mid-November.
And if it didn't, or if it happens again?
They warned that a prolonged shutdown could cause more delays in contract awards, funding freezes, and it could hit their cash flow if government payments get held up before year-end. Just shows how sensitive even these giant companies are to the budget roller coaster in Washington.
Okay, so let's try to synthesize this. What's the core takeaway for you, the listener? It seems like Northrop Grumman is making these huge focused investments, over 4% CapEx, billions in digital, and translating that directly into execution on critical programs like B-21, IBCS, ramping up rocket motor production.
Yeah, they're essentially betting heavily on solving the capacity problems the government desperately needs fixed. And by doing that, they're building a really strong, financially resilient position for the next few years.
That commitment to high CapEx, that really stands out. pouring money into capacity to meet this overwhelming demand. It almost feels like they're trying to make themselves indispensable.
You could definitely see it that way, becoming the bedrock industrial capacity partner for the DoD.
Which brings us to our final provocative thought for you today. We're seeing this intense pressure, really a demand, from government for industry to invest way more in production capacity in R&D. Is this fundamentally changing the deal between the big fence primes and the government?
Interesting question.
Are we shifting towards a model where guaranteed long-term production is maybe valued even more than traditional short-term shareholder returns? And if so, what does that mean for companies that aren't investing at this kind of aggressive level? Does the price of being a top-tier defense contractor just keep going up?
It certainly suggests the barriers to entry, or maybe just the cost staying at the top table, are rising significantly. Something to watch.